Hi, Heather Takahashi, Lord Abbott. I had 3 questions. Number one, the 100 million to be invested in new business, what's the ROI on that? And then the TCS contract, if they don't, or if you guys don't meet your objectives, what are the consequences to TCS? Is there something to align their interests? And then third question on LTC, severity is a pick. So this is more a request. Could you disclose metrics to allow us to evaluate the conservatism in those picks?
You want to do we'll do the long-term care one?
Sure.
So on all new products, new sales, we have to meet the pricing standards that we abide by. So that means positive MCVNB. That means, sorry, go ahead.
Sorry, what I actually meant was sorry, I was actually referring to the runoff, the legacy business. So for the disabled life reserves for long-term care, severity would be a pick.
Yeah, so, sorry. Do you want to start with long-term care?
Oh, sorry.
I was taking your questions in order.
Oh, sorry. I misunderstood.
No,
sorry.
That's okay. So we'll start with new business growth, new business investment. So we have pricing discipline in place, positive MCVNB, positive IRR, and a cash flow payback period of 10 years or less. Those are pricing disciplines we abide by, and that's what we go to market with. So I would argue that the best place we can invest shareholder capital is in profitable new business growth, which will lead to underlying earnings growth, as well as capital generation growth that Michiel demonstrated. As it relates to your second question on TCS, the terms of the contract, there are key metrics that TCS must abide by in terms of delivery. There are 2 elements to think about when you think about TCS. I would suggest, just to keep it high level, we could have far more detail in the breakouts, and I suggest we do. One, they will be working on the one hand at sunsetting and decommissioning all of those 26 legacy administrative systems that we talked about, and converting those over to the bank's platform. The timeline to do that is approximately 5.5 to 6 years. That is how TCS, that is their expertise, their competency, if you will. They're an IT technology leader. And by reducing the footprint, those 26 down to the bank's platform, obviously there are savings involved for both TCS, our partner, as well as that's where our savings come from. Concurrently, we will be, starting Q2 of next year, putting all of our, as I mentioned, all of our life, annuity, and health products onto the bank's destination platform. Again, there are standards that we have in place with TCS that were negotiated as part of the contract in terms of what we do, what we're required to do and perform, and what they must bring to the table. And there are contractual provisions that are clearly spelled out in the contract in terms of both, if you will, carrot and stick. So there are penalties involved if they're not able to meet the execution per the terms of the contract. I'll give you the long-term care one.
Sure. So all of our assumptions that we use for our long-term care book are informed by our own experience, industry experience, and publicly available information. And so in the deck for the side meeting, we have provided more detail on a number of our assumptions, including our claims assumptions and the sensitivity that our assumptions have to changes. I'd be happy to discuss that in more detail in the side meeting.
Cor Kluis, ABN AMRO. A couple of questions. First of all, about new products. You want to grow a little bit the business going forward. Could you indicate in which product lines you want to grow, and given the higher interest rate environment, what is different than in the past? And the second question is about capital generation. It's going up from 1.1, 1.2 billion euros. Next year, you also say the cost will go up by 100 million euros. So basically, your profit is growing even faster. taking that into account, could you give us a little bit of bridge from the current capital generation normalized to the 1.2 billion euros next year? Is it all coming from cost reduction or revenue growth? Last question is about acquisitions. Given the capital position of Aegon, which is quite improved, of course, what are the spots where you would still like to strengthen by doing some, if prices are attractive, of course, add-on acquisitions for the US and if you have time, maybe also for some other countries?
Okay, in terms of, I'll take the first part and then we can pass it around here. In terms of where we're looking to grow, I would remind you to take just to set context and give some background for those that may be newer to the company. We went through a very lengthy process in 2016 to look at the full panoply of products that we sell in the market. And we have reduced and eliminated a number of those products that we've deemed as non-core. Some of those were sold, some of those have been run down. What we currently have in the portfolio, and you saw some good snapshots here in terms of our current market position or what we're moving forward with. So we've simplified and rationalized the product offering. And the products sort of fit under those three pieces. So workplace, what do we sell in the workplace? Retirement plans, DC, DB, total retirement, voluntary benefits. And as I mentioned in my presentation, we are the only company that has a top 10 position in both retirement and voluntary benefits. And we've now gone out to the states. We've got approval in 43 of those states to actually put bundled pricing together so the plan sponsor can pay less if they bundle. This is a common practice in the property and casualty business. We are the first to market with that in the life and retirement space. Quite unique, and we'll be rolling that next year. On the individual side, again, you got a good snapshot of what we're selling there. So that's a number of life products, IUL, life combo products. These are the fastest growing, by the way, life products in the market. So people always talk about life insurance not growing. If you look at life combo sales, Michiel talked about it in his presentation, they're actually growing quite rapidly, and we're a leader. IUL, we're a leader. Those are the two fastest growing products in life. But of course, we have term, whole life, and other of those core products. In that space as well, we have variable annuity. That has been a key driver of both cash flow as well as earnings for us. We're well positioned there again in the top 10. And then advice and guidance, just to give you, sort of high level, we've got managed advice both there and at the workplace. Managed advice is I see the quizzical look on your face. Managed advice is an algorithm-based engine that helps with asset allocation and fund selection at the individual level, either at the workplace or through our advice center that Phil Ekman can talk to you about in more detail. IRAs, mutual funds. So you think about it at a high level, we help people save, invest, protect, and retire. And those products that fall under those four things, and you'll hear a lot about this in your breakout with Dave Paulson and his team, who runs sales and distribution, is where we play, and you saw the top 10 positions across those key products. Sorry.
Yeah, in addition to that, I think one of the fast-growing products in the coming years will be fixed index annuities for us. We've added distribution recently. So we would expect to see more sales in that product as well. So, Cort, just to be clear, I was talking about $1.2 billion of capital generation, right, for the US, and it's really driven by the growing cash flows from the in-force, from the business that was put onto the books over the last couple of years. So the cash flow from the in-force is growing. And that allows us to invest more in new business and actually have more normalized cash flow that we can use to remit capital to the group.
I'll say a few words on the last question, acquisitions. I think we've been very clear that our focus is on organic growth. We want to leverage what we have, want to grow the business we have. Our best investment is to allocate capital in our own business. We see the highest returns, but always lowest risk because we know these businesses well. But we also looked at ways of leveraging our existing capabilities. The UK is a good example, as you know, co-funds and BlackRock's DC. The US is a good example with Mercer, where we have a platform and we effectively don't buy a company or a business, we acquire customers in one go. I said it a number of times, co-funds was effectively an acquisition of 900,000 customers who put on our platform, and we paid £150 per customer. which is a cheaper way than going out one after other for 900,000 customers. So that is a concept. And I'm just repeating what we said a number of times, because I think there was a question you asked. In the Netherlands, we said we'll look at anything that is of any substance in the Netherlands. We'll also pass, as you've seen this week, we clearly passed on Loyalis. If it makes sense for us, we'll have a good look. It has to be really meeting our financial hurdles in a very clear way.
Hi, David Modemadden from Evercore ISI. Just a question on the fixed annuity book in the U.S. There have been a number of announcements from the U.S. peers that the market for sales of these types of businesses or reinsurance transactions is pretty vibrant. So just wondering what your thoughts are on that, and if you'd consider reinsuring or divesting that block. Second, just on long-term care reserves, just wondering the trajectory of growth in those as the block is still aging. I think they grew roughly 5% last year. When do you expect these reserves to peak? And also, just thinking about the capital required to back those, when how much will the capital required increase over that time frame as well? And lastly, just on a question on the severity in terms of on-claim lives. We've seen in the industry that claims durations have been extending, and just wondering if you guys include that claims durations will extend in your active life reserve. Thank you.
I think those are all yours.
Nice. Okay, on fixed annuities, yeah, we've noticed the same thing going on in the market. We already have quite a bit of reinsurance on our existing block of fixed annuities. So we will continue to evaluate options that we have there. So we won't hold back. If we see a good deal, we will look at reinsuring part of that business. But we're also very happy running it off. It's been performing really well in line with our expectations. So we'll look at market opportunities and opportunistically in that way. Long-term care reserves, yes, you're absolutely right. They will continue to grow over the next years. I think the peak of reserves will be reached around 2030. So that's another 12 years of reserve growth that we have in front of us. I have to get back to you on what capital growth over that period will be. I don't have a number for you from the top of my head. And then we've seen the same trend in claims duration. We set our reserves based on our experience, and so we have been reflecting that in the way we are setting our reserves.
Yep, Benoît Pétrarque from Kepler Cheuvreux. 3 questions on my side. First one will be on the special dividend. You pay 150 million in H2. Your LBC ratio is at a good level, also on the pro forma basis. You have the merger of Transamerica Advisors next year. What is your view on further special dividends from the US next year? And then also on the dividends guidance, which is a rising dividend for next year from the US, how the market could impact this guidance. Just wondering about to which level in terms of S&P or credit spreads are you happy to keep this guidance, and which level you might actually become a bit more cautious on that one. And then the last one will be on the fixed annuity book. How much capital generation is included in your 1.2 billion from this book of business? Thanks.
Again for you.
You're on the hot seat again.
Sorry? Yeah. So Dividends for 2019, I would expect over the coming years to slowly grow based on our increasing capital generation, the normal dividend. We haven't made any decisions on additional dividends. I would expect, like we've done in the past, that if we free up capital by selling businesses or anything like that, that we would upstream that capital like we have done in the past. On the other hand, there isn't much left to sell. So we really have worked through the substance of all of what we call our non-core businesses, and so there's very little left there. So I would, if I were you and building a model, I would just include 900 million as a regular dividend for next year. Fixed annuities.
Capital gen from fixed annuities.
Capital generation from fixed annuities. I think it currently will be somewhere between 100 and 150 million annually. It is broadly consistent with an after-tax number for the earnings. So that's sort of an indication of where that is as part of the capital generation.
And the sensitivity.
Sorry?
The sensitivity was a question about.
Yeah. So and your question was regarding capital generation, right? Or was it?
It was also on kind of your guidance of rising dividends for next year to the kind of the 900 million or sustainable.
Yeah, right.
In which market you keep it and which market you.
Yeah. So we make assumptions as we set our plans for dividends. We make assumptions or expectations for capital generation. We use assumptions also for impairments, for instance. And so even though we effectively haven't seen any impairments over the past 6 years, in every year we will include an assumption for impairments, right? So for next year, we wouldn't go in our assumption up all the way to what the long-term average is, which is somewhere around 25 basis points. But not that high, but we would make an assumption about impairments. So I'm pretty comfortable with that guidance for the coming year.
Good morning, Joel Gross from ICMA Retirement Corporation. I would appreciate it if you gentlemen could give a quick overview of Aegon's other American operations outside of the United States, particularly Mexico and other places.
Brazil.
Sure. We have a greenfield startup operation in asset management in Mexico. It's called Aegon Transamerica. You won't see it showing up in a material way in the financial statements. As I said, it's a new venture and very little capital investment. You're talking about $25 million, just to give you a ballpark. We have a very successful joint venture in Brazil. And we've been involved with our partners in Brazil now for approximately 10 years. It's one of the fastest growing life and asset management companies in Brazil, run by a great leadership team. And we can talk more about it in the breakout. It contributes a few million a quarter to our underlying earnings. So again, when you put it on the scale of the U.S. business, it's relatively small. Having said that, when you look at it, the growth rate and the capital gen and the performance of the business, the top line growth, it is doing exceptionally well. But again, in terms of its overall impact on the U.S. or group, it's still relatively small.
Hey, sorry, hi. Hi, Hadley Cohen, Deutsche Bank. 3 very quick questions, please. Your RBC was clearly very strong at the first half, 490. Is it possible to, given the volatility that we've had in recent months, to get a sense of where you think it is today? Second question is, if I go back to 2008, 2009, I think your cumulative credit defaults over that period were just over 200 bips. And I think you give a sensitivity to 200 bip defaults. Your portfolio has obviously changed quite a lot since then, though. So is it possible to sort of quantify what your default experience would be on the current portfolio based on the 2008, 2009 experience. And then final question, just very quickly on the Mercer transaction. I think in the first half of the year, you still were seeing outflows in that business. How have those flows compared to your expectations? At what point do you expect them to sort of trough, and when can we expect them to reverse and start growing again? Yep. Thanks.
Yeah. So we had 490 million of capital generation in the first half. I would expect for the year to be around the levels that we have been last year, so around 1.1 billion for the year. I think that's a fair assumption. On our credit portfolio, so the sensitivity we give you is based on an 97.5 percentile event, which is roughly consistent with 200 basis points. You point out that our portfolio has changed, right? Predominantly, the size has changed, right? We were in the crisis; it was probably a portfolio of around 130 billion just before the financial crisis. We're down to less than 80 billion at this point, and so that is the main difference. It remains a very well diversified portfolio. I don't think that there are specific industries that concern us at this point as industries. There are a number of names that we're tracking, but they're spread out through different parts. So the sensitivity you have for the 200 basis points it is a good one. You can use that for a 97.5 percentile credit event, which it is a pretty severe event.
Can we do Mercer?
Mercer, you want to?
Yeah, sorry, can I just quickly come back on the RBC ratio? I was more interested in the impact from market movements since the end of the first half,
Limited,
rather than the actual organic capital generation.
Market. In the third quarter, we had positive market, so we would have had more capital generation than what we would normally have.
Okay, but I think markets are slightly lower now.
Right.
But, yeah,
so
okay,
we've given back some of that. But, I think all in all, capital generation, whether it's normalized or including market impacts, I think where we are today, I think some of the positives that we had in the first quarter will be given back here in October and November, but I don't think there's anything major going on.
Okay. With respect to Mercer, remind you what we purchased. It was a strategic acquisition first and foremost. It allowed us, as Transamerica, to get into the jumbo space. Our pension business has been extremely successful over decades in the SME market, small, medium, and large, but we did not have a presence in the jumbo market. When we did the transaction, it came with a significant amount of assets, 50 billion, and remind you the purchase price was 75 million. There was an upside available, an option, contingent upon retention rates. Because when you're doing an institutional transaction where you're dealing with plan sponsors who are, in fact, fiduciaries for their employees, you're going to see some kind of shock lapse. So we did price a shock lapse in. Directly to your question, I would say the lapsation we experienced was higher than our pricing assumption on a shock lapse basis. Having said that, we're now actually, if I look at the clients we retained, I think we're going to get into a normalized kind of run rate in terms of net deposits starting in 2019. I think most of the challenges are behind with respect to that block of business. And of course, we've got healthy cash flows, gross deposits, as well as net deposits on our core legacy books. And the sales pipeline, if I look into the sales pipeline, within that pipeline, there are a number of jumbo opportunities. We've got to close them. But we would not be in that market had we not done that transaction. So I hope that answers your question.
Hi, it's Johnny Vo from Goldman Sachs. Just a first sort of big picture sort of question. There's been a lot of portfolio trimming over time, and so you've done a good job there. But is that the end of the portfolio trimming from Aegon, or there still seems to be quite a tail of business That's the first question. Second question is just regarding, the consolidated RBC ratio and the sensitivity to equity markets. I guess from a legal entity perspective, you need to protect each legal entity. So how sensitive is the VA book to downturns in market, and how much liquidity are you keeping in the US holding company to meet all the legal entity requirements? And the third question is just in regards to your hedging cost. Those hedging costs, are you using a realized vol that you use in your reserves of around 18, I think, or are you using implied vol? Give us that. And finally, just if you can give sensitivity to basis risk on the hedging as well, on the capital base. Thanks.
So Johnny, let me start. Thank you for seeing that we've been doing a lot of portfolio rationalization. We've been looking at our businesses within countries, so good examples in the UK, Netherlands, US, which you're well aware of. We'll also be looking at countries that we have been exiting. So there's quite a list of them, as you know. Just recently we announced Czech and Slovakia. We continue to look at all our business on an ongoing basis. I think one country I've been a bit more specific about, and that's Japan. We said we'll be exploring the various options we have. We are continuing to do so. But we will continue to look at those businesses that fit our strategy, those businesses where we are not distracted, and those that really also bring an amount of scale and size. And that's really very important. So you will continue to see portfolio rationalization.
So where it comes to variable annuity hedging, we basically run, or equity hedging, we basically run a number of programs that are special to books of business, like for variable annuity, mainly withdrawal benefit book, that is an open book today, our IUL business, and a number of other of these kind of plans. Those are dynamically managed programs, basically on a fair value basis. And then for the remaining equity risk, which includes our DB/IB book from the early 2000s and late 90s, we have an enterprise hedge program. And so the cost that I was referring to of 45 million a quarter is related to that specific program. In our fair value reserves, we use in valuation of volatility. We use implied volatility, and so you will always see a bit of a result from your realized volatility being different than your implied volatility. So there's some of that. And then obviously, actually we have done a lot of work over the past years in Owen's group. We have done a lot of work to limit the fund mapping risk and get more information on the underlying funds and get it faster so that we can more precisely hedge. So there's always going to be some risk, obviously, but we've been limiting that over the last couple of years, actually quite substantially.
Good morning, gentlemen. Mark Cohn from Guggenheim Partners. Just a few questions. In regards to the life and annuity administration with TCS, can you maybe give us some color in terms of the feedback loop that occurs with TCS, with your internal actuaries in terms of mortality, morbidity, trends that would occur that you would price appropriately and effectively to be on top of the behavioral or even financial loss assumptions that you originally placed in? Second question is, appreciate the color on the RBC ramifications to the variable annuities, but would like to get some ramifications on what the effect is on the conditional tail expectation to a 98%, which will be incorporated by the NAIC. Thirdly, on the long-term care book, can you provide us what the buffer is between your IFRS and your stat reserves? And then finally, given the volatility that's occurred in November and then earlier this week, could you give us some color in terms of what your hedge effectiveness was?
In 4 minutes or less.
Sure. So your first question, TCS will be administering policies only, right? So we will get all of the information from all of the policies, and we will run our own valuation and our own pricing. All of those things will remain with Transamerica. So we'll get just the basic policy data that we need from them. There's no real actuarial assumptions that we need to get from them or anything like that. Okay, on hedge effectiveness, I think that, but Owen can correct me if I'm wrong, but I think over longer periods of time, our hedge effectiveness has been anywhere between 96 and 99%. I don't think that the last couple of months has been any different. And he's nodding, so I'm good there. I'm sorry. Well, yeah, oh, yeah. So the cutover to the new variable annuity framework, we do not expect any impact on our reserving or on our capital. So effectively, we are at that level. And then
the buffer between IFRS reserves and stat reserves on the long-term care.
On long-term care. So if you look at our IFRS reserve, excluding the shadow reserve, so the reserve that is available to pay claims, that's at the end of the year was 5.4 billion. The stat reserves were 5.8 billion. So I think, so it's about $500 million over. Stat reserves are about $500 million higher than IFRS reserves.
Yes, Robin van den Broek, Mediobanca. I have one question left. In your slide deck, you also give some updates on the model, the margin on products. There, I think if you would use those on H1, I think the impact on underlying earnings before tax is roughly neutral. But yeah, those assumptions do include the cost cuttings you've been doing. So probably there's some margin pressure underlying those businesses. So wondering if you can talk about general trends there, and how important will cost cuts be going forward, or are you expecting to basically show growth purely on the back of net inflows going forward? Thank you.
I would posit that margin compression has been real, exists today, and will exist in the future. It's a competitive market. We're in the United States. It's a hyper-competitive market. So that is why a deal like TCS is so monumental in terms of its transformational impact for us. As I said in my opening remarks here, there is no company in our sector that at the end of, remember what this looks like, at the end of 5 years, our entire in-force of life, annuity, and health will be on a modern digital end-to-end platform. That means we will have a lower cost base than what generally you will see in the market. In our case, we're sunsetting, with the help of our partners, 26 admin platforms. I would tell you that what will come with that is also process improvements on the side of our business, because legacy admin platforms were built in a very different time. They were not designed with today's technology. They are not designed with a digital-first direction. This didn't exist. Your iPhone didn't exist when these platforms were put in place. So we see process improvement. We see enhancement. I'll give you one example that this will enable, and I talked about it briefly, automated underwriting. We spend a lot of money, as do our competitors, on medical, let's say, fluids. Once you get your data in place and your data analytics, and you can drive a couple things. One, you can drive costs down of issuing a policy. 2, you can improve the experience. 3, you can improve the placement ratio. 4, you open up a new avenue of distribution. So for example, why don't financial advisors sell life insurance today? Because the process looks like it did in 1970. It's horrible. We think this is a wonderful opportunity for us to not only drive costs down and efficiency through simplification and modernization on brand new admin platforms that drive into the data analytics layer, that drive into the presentation layer. So I see sales benefits, I see experience benefits, I see a competitive advantage through speed, because no one will be able to match, in my estimation, no one will be able to match the speed we'll be able to put products on because you're not having to deal with this legacy, heritage, complicated involvement. And that's how you'll be able to deal with margin compression and changes in market. Right? So it's not just response to competitors. Competitor A does one thing, competitor B does another. It's also how do you evolve and change your product set as markets change. A number of folks in here had questions around volatility and its impact. I would argue in today's world, you've got to be faster than the competition. So yes, it's competitive. Yes, TCS, our partnership with TCS enables us to be a lower or low-cost provider, but importantly, it positions us for sustainable, profitable growth. All of that is tied up in that strategic joint venture.
Thank you very much, gentlemen, for taking the Q&A. Hopefully behind me the breakout rooms will show up. There are 4 breakout rooms. The breakout starts in about half an hour, a bit earlier than that. There's one breakout room here on the 7th floor. But to stick to our wealth and health theme, we also have you walking around the building a bit. So there are 3 rooms, 1 floor down. So please keep an eye on your schedule on where you have to be. You have about 5 minutes in between the meetings to change rooms. Thank you.